The character of a hedge fund manager is best described by how they get paid. Who you are is how you get paid in this business. I want to talk about this. I want to use some examples like ARK Invest, contrast this to Orange Capital Partners, talk about our mission to generate wealth by investing in fundamentally new concepts and engineering practices with large impact, contrast that to other funds and other strategies, and finally draw a conclusion towards the year end into how we see this year and how we see the next year evolve. This is the Not Even Wrong podcast. It's December 30th, 2020. This is Krim Delco. For the day, the fund is up. Actually, since the last update on December 24th, the fund is up roughly 8%. The market's up about 2%. We are up for the year 420%. The market's up 16%. We're outperforming by 404%. So I want to talk a little bit about compensation in the hedge fund business. And I think in particular in this business, but in pretty much any other business, compensation is key to signaling of how people will behave. Compensation is, to use Reed Hastings' words, part of the culture. Hastings, actually, he didn't talk about compensation. I'm sorry. What he said is culture is what gets you promoted and what gets you fired. That's what culture is. And I want to extend that to culture is what gets you paid and what doesn't get you paid. So your culture is shaped by the compensation structure. And I think that's absolutely key in the hedge fund business. Now, before I go further, let me first set the stage. I want to contrast Orange Capital Partners with a classical New York hedge fund, and I want to use third points, Dan Loeb's third point for that. And I want to use ARK Invest by Cathie Wood as another example of an asset manager. And I want to talk about the compensation structure, and I want to also try to draw conclusions on what we should expect from funds like that and what you can actually infer for the future just by looking at the current compensation structure. So let's start with Orange Capital Partners. We are a multi-asset, multi-strategy hedge fund. That means we do pretty much anything that we think can make money. Our purpose is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. So within that, let's call it all our own Hilbert space of all infinite opportunities, we chose one very particular space. And that is the space where new concepts and engineering practices have the potential to create enormous amounts of impact. That's where we see wealth creation. We therefore choose to be compensated solely by performance fee. We have no management fee. We have no hidden fees, no nothing. The only fee we get from our investors is if they make money, we take a 20% cut of their profits. If you put $100 in our fund and you have $200 at the end of the year, we would take $20 out of the $100 of your profit. This is it, and you keep going with your $180. So this is very important for several reasons. It incentivizes us to take positions that have high potential returns. It also incentivizes us not to lose money because we have a watermark. That means that if you lose money, we have to earn it back before we make fees. So if you give us money, we make nothing unless we make you money. And therefore, our incentive structure is very clearly aligned with yours. It's aligned with our mission, and that is very important to us. I want to contrast this to ARK Invest. I don't know exactly what their incentive structure is and their pay structure, so I'm just going to guess now for the sake of the argument. So please don't bombard me with comments now that I'm wrong. I'm probably wrong because I don't know the inside of ARK. I'm not an investor there, but I guess ARK Invest is a traditional long-only asset manager and therefore charges a fee on net asset value. So it's a management fee, and let's call it 50 basis points. So at the end of the year, they look at their net asset value, let's say it's $1 billion, and they charge 50 basis points, that's 0.5%, which would be on $1 billion, $5 million. So they just charge them a $5 million fee. Maybe they average it throughout the year. Maybe they use the beginning of the year, the middle of the year, the end of the year, NAV. I don't know exactly, but I'm just using it as an example. I'm not saying that's what they do. They might do something else. But given the way they structure, the way they're communicating, I guess this must be the way they're being compensated. And this is already a very good example of why I think that compensation is a very good tool to analyze people's behavior, because based on their behavior, I think I'm able to infer their compensation structure, and this goes also the other way around. Based on the compensation structure, I should be able to infer their behavior. So what what is the incentive for ARK Invest? Well, because they're being paid a certain fixed percentage fee on their net asset value, and the net asset value is driven by two factors, which is increase in appreciation of the fund, and second, in capital inflows. Therefore, they control those two things. They can either do what we're doing, which is try to generate high returns on their investment, or they can spend efforts to attract new funds. Both of them give them fees, and they're both the same. It makes no difference. So therefore, we infer that ARK Invest, or any traditional long-only asset manager, again, this is just, I'm using them as a guinea pig here. Their incentive is to generate a sales organization to attract funds. So they have an incentive to go on TV, to talk to as many people as they can in the media, to be distributed broadly, so as many people as possible can invest in the fund. And that's actually exactly what Kathy Wood often says. Kathy Wood, I'm sorry. She says that she wants to give access to her funds to as many people as possible. Now, of course, she's not phrasing it that way. She's saying that because of her innovative research, she wants to give as many people as possible the opportunity to profit from her innovative research, and therefore she wants to distribute the fund as broadly as possible. And that's fine. I don't have a problem with the narratives. Particularly Wall Street is full of narratives, and whatever they are, I don't want to judge anything. The most important thing for an investor and for a fund manager or somebody who contemplates running a fund or investing in a fund, no matter how you're related to this industry, just think about the incentive structure of a fixed management fee based on a net asset value. You're incentivizing asset gathering over returns, because you can control asset gathering much, much better than returns. Returns can, by the way, can be shown in many different ways. Therefore, there's also leeway in there, but you cannot really cheat on returns. But you can show a little bit different. For example, ARK Invest has several funds. Again, I'm using it as a guinea pig. I'm not saying they're doing that, but if you have several funds, you can always show some fund which made money and others which didn't make money. In the extreme case, you could have funds that do one thing and then other funds that do the opposite, and then just always go on Bloomberg and talk about the ones that made money. But I don't think that's what ARK does, by the way. I think they're doing very solid research. I listen to their podcast, For Your Innovation. I think they're very, very solid research people. I doubt that they're money makers. I doubt that they're wealth generators, because the way they're acting. Also, another thing that I can infer from this compensation structure is they're going to be very diversified, because you don't want to have unnecessary drawdowns. You don't have, since your goal is not to generate enormous amounts of wealth or alpha, or outperform similar types of companies. Your goal is not to concentrate. Your goal is not to pick the winners. Your goal is to pick certain strategies, certain themes, and then diversify within those themes and diversify the themes. So overall, you can take advantage of markets that are in favor of you, and when it doesn't go well, you can just say, well, it was the market, it wasn't me, kind of thing. And since you're collecting a management fee, you are going to make money in good and bad days. You will make more money in good days, but you will still always make money, which, by the way, we don't. So in a nutshell, this is a kind of incentive structure that, in my view, has the potential to generate mediocrity. And that is a little bit where I see, let's say, ARK Invest going. They're turning a little bit into a sort of not a CNBC type snake oil selling investment narrative machine, but it's starting to show signs of problems. And I would suggest, if I may, this is unsolicited advice, but I'm still going to do it. It's the end of the year. I'm going to indulge myself. Kathy, if you hear this, please just go back to the drawing board and think about how, does it really matter if you manage 50 or 100 billion? Or isn't it a lot more interesting to really pick the winners, to really understand what really important future technologies and developments will be? Does it really matter if we invest in things like Uber or DoorDash or food delivery. Is that really a good way to look into the future, or is it not more important to think about something like Tesla that you've been very vocal? So isn't that a much more impactful company? Isn't that much more important? Isn't it more important to talk about, if you want to talk about crypto, then please don't talk about Bitcoin and the dollar devaluation and because that's really not your business, and it's nobody's business. It's we as citizens, we have voting power, we have lots of ways to generate the politics that we want, and just to try to be some sort of renegade asset manager owning something called Bitcoin and give it to the establishment. It's just, you're better than that. But if you want to talk crypto, let's talk about micro contracts, robots, machine-to-machine communication, machine-to-machine payments, machine-to-machine evolution, those kinds of things, embedded payments, embedded contracts in the Internet of Things. Maybe those kinds of things are interesting, not to me, but I would rather see crypto go that way. Again, 3D printing, another one of those. Yeah, it sounds really cool to print a toy at home. What is the problem that 3D printing is solving? And if the problem is to iterate manufacturing faster and those sort of things, then great. But I don't see the value right now in that. Maybe the technology is not there yet. I just feel like it's a bit premature because the use cases are not very clear, and I also don't see disruption a la Clayton Christensen here. So I would rather see a little bit more urgency and agency in the investments, and not just spreading everything out to collect money and fees. So the last compensation fee I want to talk about now is the one, and I'm using Dan Loeb's third point here. This is a classical New York hedge fund. It's a 20 and 2, so 20% performance fee, 2% management fee. This is how it used to be in the old days. These kinds of funds are in the business of absolute returns. They invest in anything that works. They are typically, I would call, special situation funds. So they look for restructurings, mergers and acquisitions, spin-offs, new CEOs, new boards, that kind of thing. And they're actually, this Dan Loeb is an activist. He just recently started activating against Intel. Intel is in trouble. Intel has problems. So he's doing things, stirring things up. And typically what these funds can generate with situations like that is a 20-30% return. Maybe they take big positions. For Wall Street, rather big. They can have 5 to maybe 10% of their portfolio in one particular stock. That's not really what we consider concentration. But again, in the world of Wall Street, where people have 50 to 100, 200 positions per fund, that is a relatively high concentration. These funds are in the business of generating that kind of what we call alpha through really trying to find very unusual, difficult situations, difficult to analyze situations. They try to arbitrage that and make money. Now, maybe that worked in the past. We don't believe that works in the future because it's A, too competitive, B, a lot of their strategies have been internalized by the companies and their management consultants, and therefore there's a lot less opportunity to actually be active and do things. So, but the behavior of these types of funds is that they have sort of, they're like us in terms of trying to generate lots and lots of high returns, but they're also like Cathie Wood in the sense that they want to gather assets, because they have both. They have the management fee and the performance fee. And I would say, from an investor perspective in a fund like that, you don't want both. You either want us, Orange Capital Partners, high returns, no management fee, or you want Cathie Wood, pedestrian returns but no performance fee. Pedestrian relative to the hedge fund industry, but certainly not pedestrian relative to the rest of the market. The rest of the market, as far as I'm concerned, with zero interest rates and those sort of things, should not expect more than a few percent return per year in any kind of asset class, real estate, gold, stocks. So if somebody can do 10-15%, that's phenomenal. That's unbelievably good. But it's not the kind of return that we're looking for. We're looking for unlevered 15% returns over the long term, and that is so a CAGR of 15% is our threshold. We hope to do better, but that is our threshold. I think you can achieve that with us. By the way, this is after fee. And I don't know what Kathy would say after a few drinks, what her return objective is. But I think given her structure, I don't think that she has the potential to do better than 15% CAGR after fees. And as far as Dan Loeb is concerned, I don't think these types of funds have any kind of chance, given the fee structure, to generate anything above single digits. I don't think they maybe at best can beat generally the market by a few percentage points. But they're not in the business of generating wealth for their investors. They're in the business of generating wealth for themselves. And more importantly, they're in the business of promoting themselves and being important and things like that, which partly is their business. To be activists, you have to be important. But anyway, to finalize now this episode, incentive structure is instantiated in compensation. Compensation drives behavior. Culture is what gets you promoted and fired. Culture is what gets you paid and not paid. And we have three types of payment structures in the hedge fund business. One is ours, only performance fee. The incentive is to generate high returns and generate wealth. We have only asset management fees, meaning fixed management fees, relatively low fees, which incentivizes asset gathering and therefore makes you more of a narrative, selling to mom and pop, being the confidant, a bit like Warren Buffett is like that. And then third is sort of the classic New York hedge fund. On Loeb is as an example, third point, where you have both. You have the management fee and you have the high performance fee, and therefore you also have both strategies. You have a lot of staff to gather assets, and then you take relatively concentrated positions also to generate high returns. Problem with that is we don't see the strategy as working anymore because it's too competitive and it's too instantiated in the market already, and there is no incentive to actually try to be unique. And this brings me to the last point. Now, after all of this, the conclusion is, in our view, that the only real wealth generating funds are those that are structured like ours, like Orange Capital Partners, because the only incentive structure, the only payment scheme that actually incentivizes you to be unique, to take risk, to put your own skin in the game, to accept defeat and accept the possibility of suffering as a return for the possibility of doing really well. The only way is by having this kind of structure and having this kind of behavior, you will also be able to find those types of companies. So if you don't internalize that kind of thinking, if you don't internalize the thinking of an entrepreneur, and not necessarily, I'm not talking about technology and strategy, I'm talking now about the feeling of how it feels to be an entrepreneur, to actually put it on the line, to actually stand on that cliff and jump and either survive or not, and swim through that storm and come out on the other end as a winner or maybe as a loser. But you have to internalize that feeling. It's like wine. You just have to do it. It has to sit. It's not going to come from the sky. The only way you can get there is by having the right incentive structure to create that kind of culture. So the only funds, in our view, that have the potential to generate wealth are those that actually pick the kinds of entrepreneurs that have the potential to generate wealth, because those are the only people who actually are able to generate wealth. Thank you.